Good afternoon, ladies and gentlemen. Welcome to this conversation that we're having, roundtable on mobilizing local savings at scale to finance clean energy projects. My name is Wale Shonibare. I'm the Director for Energy Financial Solutions, Policy and Regulation at the African Development Bank. We have the pleasure and the honor of having some distinguished panelists with us to engage in this conversation. So let me start on my far right. We have Mr. Vivek Mittal, who is CEO of Africa Infrastructure Developers Association. We have, right, we give him a round of applause. Then we have Mr. Chris Canavan, who is the Chief Executive of the Global Carbon Market Utility. Thank you, Chris, for joining us. And then we also have Mr. Chinua Azubike, who is the CEO of InfraCredit. Thank you, Chinua. And last but not the least, Mrs. Tarie Gbadegeshin, who is the CEO of ARM Harith Infrastructure Fund. Thank you very much. And soon to be CEO of Climate Investment Funds. So the size of our portfolio is going to multiply to $10 billion. So well done. So just in terms of the order of play, I'm going to make a very brief presentation, just stating what the problem is that we're trying to solve. And then we have solutions that are being implemented by all of our institutions here, and of course our practitioners are very experienced in the field. They are going to share some of their experience with us of creating local currency instruments, blending and innovative structures. And then there's also a moonshot idea that we're going to discuss, because we have quite a road to travel in Africa before we can finance our infrastructure in local currency. You know, as with most developed economies and some other emerging markets. So without further ado, let me get into the presentation, which will be very brief. I have a few slides to present, and then we will have a very interesting conversation. So what problem are we trying to solve? You know, in the energy sector, we have a huge challenge. You know, 600 million or so Africans without access to electricity, nearly 1 billion without access to clean cooking. $200 billion investment required annually for Africa to achieve its energy and climate-related goals by 2030. Africa will experience 100% increase in electricity demand by 2040. Africa currently accounts for only 3% of global energy investment and a mere 2% of the world's clean energy investment. So meeting this challenge requires a combination of financing resources. Obviously, the MDBs, multilateral development institutions, are playing their role, but it's only a tiny drop in the ocean to what's required. International investors want to play their role. Some of them are already involved, but we have to make the environment conducive. But most importantly, it's the local investors and the developers and the ecosystem. That's what's going to make us achieve progress, because if the locals are not investing in their own markets, in their own infrastructure, in their own future, it's very difficult to expect the outsiders to come in. So we need to multiply the investment that is available. And the sustainable way to do that is not by continuing to borrow in hard currency to finance our infrastructure, because that's not sustainable. There's significant forex risk. There's currency mismatches that we have seen. Brothers and sisters here who are from Nigeria will know what has been experienced in the past few years. Imagine borrowing in dollars for 25 years in Nigeria. Almost every 5 years, the amount of your loan doubles or quadruples. And it's not sustainable. And if you're financing infrastructure, you cannot always pass that on to the consumers. So we need to find a solution. So local currency, why isn't it working in Africa? What are the issues? Macroeconomic conditions obviously have a huge role to play, where governments are running deficits, borrowing to pay salaries, crowding out the private sector. So you inevitably have inflation if government is printing money to borrow, and interest rates obviously are very high. If you're borrowing in double-digit interest rate, the compound interest is going to kill your project over a long term. Yeah? Lack of financial markets depth, in many countries, we're not aggregating enough local savings to be able to finance infrastructure. How can we multiply and aggregate local savings? One of the biggest pools of local savings in the world is Japanese postal savings. Huge. Japan borrows a lot, over 100% of GDP, but most of that debt is local, and that's much safer than having foreign currency debt. And the Japanese people, in order to rebuild their country, are happy to take very little interest. The government takes advantage of that. Why aren't we aggregating pools of local savings? Why are we promoting through our policies capital flight? There's some economies, the minute people get their money, they want to change it to dollars. It's not helping the pool of local savings. So there's a risk-return profile. We don't have enough patient capital. So for now, a lot of the discussion talks about more blended finance, more hard currency, more, even though this discussion about changing the financial architecture, it's only a tiny drop in the ocean, because the blended finance, however well-intentioned the donors are, all the donors have their own problems. They're not going to continue to provide blended finance, because blended finance is a fancy word for donor aid. You're getting grants from donors that you blend with your commercial facilities. And that pot of money is not inexhaustible. All these countries have their issues as well. Then there's limited local expertise in certain markets, structuring enough, even where you have the savings, to translate those savings into investment into infrastructure. The products may not be available. And that's why what Chino is going to say about infracredit is really important, because for a long time, people are asking, why aren't pension funds in Nigeria investing in infrastructure? They didn't have the product to channel, because they're not going to just take a stake in an SPV. They need liquidity, and they need certain safeguards. And then the policy and regulatory environment. What are we putting in place? So if we look at all of those things, we find that, okay, I forgot to change the slide. So that's a slide on the issues. So you find that what I've talked about, there's some key indicators that depict a country's readiness to deploy local currency financing at scale. Obviously you need GDP growth. Once upon a time, India used to take loans in hard currency to do their projects. Now, most of the projects is in local currency. Vivek was there when this whole thing was started. He's going to talk about that in a minute. And then, what's the local stock market capitalization? What's the size of commercial banks' assets, insurance company assets, corporate bond market capitalization, government market bond market capitalization? What's the size of the pension fund assets? What's the size of, bond issuances? And when you look at this graph here, it actually lists in terms of size, with the biggest stock market in Africa being to the far left, as I face the screen here, right to the smallest. So obviously South Africa is head and shoulders above many of the others, but you also have the likes of Morocco, Mauritius, Nigeria, Botswana, Tanzania. These markets, you find that these countries, not all of them are borrowing in local currency. In Mauritius, they do a lot of their deals in local currency, so with Morocco, so with South Africa. Nigeria is up there. We need to. That's the way forward. When people come to me for loans in hard currency from Nigeria, I tell them, look, let's explore local currency options if you're earning local currency. If you're Nigeria LNG, we're happy to finance you because you're earning dollars, but if you're earning local currency, the Nigerian market is big enough for us to try and find solutions to financing our infrastructure in local currency. And there are other countries that we are looking at. So this is the final slide, not quite, but the penultimate slide. Here, we've just looked at some indicators. At the bottom of that slide, you have South Africa. That's where we want to get to. So, for instance, local stock market capitalization. Okay, this is a bit dated. As of 2019, 300% of GDP. You know, size of commercial bank assets, 116% of GDP. Size of insurance company assets, 66% of GDP. And what you will see is that there are certain countries that have some of these indicators. They are approaching the point where they can start doing their transactions in local currency. So we need to encourage that. So the likes of Egypt, Morocco, like we talked about, Tunisia. So what are the policy measures that we need to put in place to encourage more of that? So we want to talk about a few success stories. The African Development Bank was involved in supporting the Nigeria Infrastructure Debt Fund, which is a fund that is run by Chapel Hill in Nigeria, which is the first listed local currency infrastructure fund on the continent. And there, the key thing was you were able to create liquidity. The pension funds could come in. And because it's a debt fund, within the first quarter, they were able to distribute to the investors in the fund. So that has been quite successful to the point that they're probably the second largest issuer of green fixed income instruments on the market today because, you know, they've been able to come back to the market time and time again. InfraCredit, who are wrapping bonds, you know, to provide the credit enhancements, increase the rating of the bonds. Again, because pension funds have to, you know, invest in credit, investment-grade instruments. So again, the African Development Bank has been involved in supporting InfraCredit through a mezzanine facility. So this quote here, saying that no country has ever developed based on the savings of other countries, right? African countries need to grow their domestic savings and their pool of resources in a manner that allows them to rely on pooled resources to raise financing for their much-needed infrastructure. This necessitates a shift in Africa's project financing paradigm. Do you want to guess who came up with that quote? It's a very important quote. Sorry? Well, I would love if it was the president of my bank, but it's actually my quote. I came up with it. so I said by Wale Shonibare 2023. So remember that quote, you know, because, you know, oh, thank you. I'll take the applause. Thank you so much. It's my quote. Because, you know, the definition of madness is doing the same thing over and over again and expecting a different result. That's what we're doing in Africa. It doesn't make sense. So we need a paradigm shift. Now, there's a moonshot idea that I'm going to leave you with. And our panel, in their response, can also comment on this moonshot idea. Because we're talking about changing the global financial architecture. So the ideas that we come up with have to be radical, you know, and we're not hearing enough radical ideas anywhere. So we've decided to come up with this idea, and we're trying to build a coalition of the willing who will help us move this idea forward. We have to lobby our presidents. So here's the idea. The idea is that African countries should stop borrowing in dollars. Yeah? They should borrow in an alternative currency, which we're calling a units of account, right? Now, for that to be able to happen, we have to create what we're calling a Bank of African Settlements. And essentially, we're saying that African countries, in order to pool their resources, particularly their commodities, should pledge up to 25% of their proven reserves to the Bank of African Settlements. Right now, African countries that have deposits of gold, copper, oil, many of them trade through these commodity traders, Vitol, Glencore. They're not pooling their resources. So if you create the Bank of African Settlements, overnight you'll probably create the largest commodities trader in the world. And suddenly, we have market pricing power. And then this commodities Bank of African Settlements can also on-sell to the other commodities traders. But with those pooled savings, backing the units of account, if you want to borrow as a country, you can borrow in units of account, and if you need settlement into dollars, you just pay your local currency to the Bank of African Settlements, and the Bank of African Settlements will pay your lender the dollars. So there's a complex mathematics behind all of this, but if you don't remember anything else out of what I've said, what I'm saying is, one, create Bank of African Settlements. B, stop borrowing in dollars, borrow in units of account. C, when you borrow in units of account, Bank of African Settlements can give you dollars. And when you want to repay, you can pay in your local currency to Bank of African Settlements. They'll do some magic within that box to make sure everyone is being settled. And you can do that with a fixed exchange rate. And this is not new. This has been done before. Once upon a time, the world used to rely on the gold standard for trade. And the way the gold standard worked was the currencies of different countries were backed by real gold that resided in the central banks. And there was a Bank of International Settlements, which still exists today, based in Switzerland, that used to do all the settlements until we abandoned the gold standard. Richard Nixon abandoned the gold standard in 1974. So that's the presentation. I hope it wasn't too confusing, but now we're going to have a discussion. So the discussion will be broken down into two aspects. One is there are some interim measures that we're taking and some very innovative instruments that are being created to allow us to borrow in local currency. So we will get some examples of that from Tariye, from Chinua. We'll get an insight from Vivek from his experience both in Asia and also what he's doing in Africa right now. And then Chris has had experience of Latin America and also from his experience of working in premier institutions like Goldman Sachs, etc. So let's start with Tariye. We'll put you on the spot. Could you please talk to us about the innovative approach that you are adopting with your fund at ARM Harith and how you're blending local currency with the hard currency to make the transactions sustainable?
Sure, thank you. Can you hear me? It's okay? Oh, excellent. No, thank you, Wale, for having me here today. ARM Harris Infrastructure Investments, which is the fund that I currently lead, is a multi-currency or multi-jurisdictional fund that manages capital from Nigerian pension funds and international investors, anchoring of which is the African Development Bank. Thank you very much for your support, alongside other international investors. Now, one of the key differentiators that we had over the years was this interplay between domestic pension funds and international. And our successor fund is an energy transition and climate fund. And we've introduced a local currency equity vehicle that is actually going to work alongside the dollars in the fund. What we see is that there is still a need for dollars and local currency. We need more local currency, but some dollars at least for equipment, or there still needs to be some dollars in the mix. The question is really for how long those dollars are exposed. And so, to Wale's point, the idea of financing 20-year exposures with dollars is untenable. But strategically applying dollars, whether it's in earlier stages, such as project development, the construction phase, or equity, where eventually you can sell down assets and recycle, then using the domestic capital market. And that's a fundamental thesis of our private equity fund, which is that when we are investing dollars, we invest in a combination of shares and ordinary shares and shareholder loans with an objective to refinance our shareholder loans with local currency. And so therefore, we are sooner rather than later de-risking that dollar exposure and on-selling our assets into the domestic capital market. This works well in a domestic pension fund setting because they tend to not be comfortable with construction risk. Now, clearly, there are other interventions that I'm sure even Chinua will go into as to how to mobilize pension fund capital into some of that construction phase and some of that development phase. But there is actually a pretty ready way to de-risk dollars, which is build, sell, asset recycling. And we need to see a lot more asset recycling so that we can actually get that velocity of dollars that are going back to build, but ultimately the long hold for that infrastructure should be in local currency. And we think that's a fundamental, and that's how we are really focused on deploying our dollar equity. But at the same time, we also need to see more domestic capital in higher risk segments. And I'm going to leave the debt side to Chinua, but I think what we always say, there's an ecosystem for infrastructure, ecosystem of funding. There's project development, equity, debt, and other forms of instruments, mezzanine and junior. And there are different places within this that all parties should play using different forms of instruments. We would like to see more local currency equity, because even equity competes, even equity will demand certain dollar payments. And so the more we can have domestic pension funds participating in equity, the better. Now, one of the areas that we have done more work on local currency equity has been with a distributed renewable energy aggregator called the Aggregated Distributed Power Company, and AFDB has actually funded a technical assistance program for us to be able to integrate domestic pension funds to finance off-grid. And one of the things we're doing is creating a stream, because ultimately it's about creating that liquidity stream. And so one of the pieces of work is around really meeting the regulations for potentially listing equity sooner rather than later, because pension funds are much more able to invest in listed securities than they are in private equity securities. And clearly, I think African pension funds have shown that they are less comfortable with a private equity setting. So I think there's also an important innovation in private equity or pre-public equity, pre-listed equity, if you will, which is to find some different forms of hybrids. And I think that's where NIDF actually did well, was creating a listed infrastructure vehicle that does, that basically applies capital into debt. I just want to close on one point, which is that as we're trying to green African portfolios, especially domestic capital markets, we cannot ignore that the African infrastructure opportunity is a greenfield opportunity. We have to build assets. In a developed economy, you can buy, steady state infrastructure, add value to it, leverage it. We don't have that. We have to figure out how to solve for the greenfield and the construction phase. And that's why you're still going to need equity. You're still going to figure out how to de-risk that equity, how to recycle capital. And that's a big place where innovation needs to go.
Fantastic. Thank you very much, Taria. So a few key things that you said there, is even if you have to use dollars, you have to use it strategically.
Yeah.
So you could use dollars for a short term and then swap it out, bring in the local currency, which is fair enough. I mean, if you want to buy your equipment, you can convert your local currency on the day, buy the equipment, and, which is fair. Maybe you take a 1-year exposure max, and you could buy a short-term hedge for that if you have to. But this idea that you take local currency and wait for 20 years, so that's a really important point. The other thing that you mentioned, you talked about the velocity of the USD, asset recycling. If you build the asset and then you flip it, or sometimes through privatization, government builds, and then they get the investment in. When we did power sector privatization in Nigeria, $2.4 billion realized from selling 17 entities. Most of that money was from local investors. Some of them brought that money from overseas, and that's money coming back into the country. So again, the asset recycling was very important. And then you talked about the initiative you're doing for distributed energy. Again, these are small deals, but if you aggregate them and you create a company, you're creating investable assets. And the fact that we need equity as part of that ecosystem, because there's a lot of talk around debt, but it's actually really important that you have equity to anchor the debt.
Yes, that's
and
right.
So you have to create credible development institutions or companies, developers, with the appropriate structure of equity and debt. So thank you so much for that, Taria. So let's move to Chinua. So please expand, Chinua, on what the journey has been like with InfraCredit, what problem you were trying to solve, and how you've been innovating.
Thank you. Good afternoon, everyone. It's a pleasure to be here, and thank you, Wale. It's a pleasure to join this esteemed panel session. So sometime in 2015, 2016, I think then, and you happen to have been involved at the conceptual stage when you were in Nigeria at the time. The problem, the dilemma at the time was, how do we provide a form of credit enhancement that could de-risk perception of risk for companies that are developing infrastructure and enable them to access long-term finance in local currency from our pension fund market. The pension fund was fast growing. At that time, at least at the time I joined as a lead to work with the Sovereign Wealth Fund, who was the anchor investor that put in the seed capital to set up InfraCredit in 2016. The size of the pension funds was around, in Naira terms, about 6 trillion Naira. Today it's about 17 trillion Naira. So you could see how fast it's been growing, largely because we have a very youthful population and it grows about 15% per annum. But most of this money was invested in government securities. And so the challenge and the opportunity was to unlock access by de-risking these projects, essentially making them look more creditworthy by using guarantees. And so InfraCredit was set up by the Sovereign Wealth Fund of Nigeria alongside Garanco, which is owned by the Private Infrastructure Development Group. And the Sovereign Wealth Fund invested about $25 million as their seed equity then. And the objective was to get a local rating of AAA, which we did on the back of the capital structure in 2017. And they issued these credit guarantees against projects that meet the criteria so they could issue long-term local currency bonds and essentially create a new asset class for the local pension funds to invest in. And so that started in 2017 with the first guarantee we issued for a power deal a captive power project, and they raised 10-year financing from the capital market, from local pension funds. Now, that was the first time that tenor was being raised outside of the sovereign. The corporates borrowed at average of 7 years. And over time, we've lengthened that tenor by guaranteeing projects across multiple sectors, from telecoms to special economic zones to hydros, to 15 and recently 20 years. So essentially, in Nigeria today, the yield curve for corporate debt, it's as long as 20 years. And this is largely funded by local pension funds. And so what is the broader opportunity? And I think Wale's presentation highlighted the opportunity across Africa to the extent that some of these enabling environment factors do exist. In Nigeria, we have a capital market, we have savings in pensions, and we also have an insurance market that is evolving. And on the other hand, we do have projects that require a deficit, that have a deficit in financing. And so the use of credit enhancements to act as a de-risking tool plays a very critical role. You would see that it's been said that Africa pays one of the highest premiums in the world for borrowing, despite the fact that the Moody's study shows that we are one of the lowest risk continents. In fact, I think the default rates in Africa is lower than Latin America. However, we pay a higher premium. And that is in dollars. So you can imagine in local currency, the actual potential for defaults, especially when they're well-structured projects. Over the past 7 years, I'll say, we've experienced 0 losses on our portfolio, which is roughly, if you use the exchange rate at the time we guaranteed each deal, is roughly around $300 million Naira equivalent, across 16 infra projects. It's 0 losses because, again, infra as an asset class is very resilient if it's well structured. And so we have seen the role of credit enhancement in addressing perception of risk and also enabling the local pension funds to actually take a role in investing in these assets even without the need for a guarantee. So we provided a guarantee in 2019 for a 15-year green bond for a hydro project. That was the first time accessing the capital market. The second time they came to the market, the pension funds were comfortable to invest in a 10-year bond without a guarantee. So that demonstrates, again, the fact that the guarantees play a catalytic role. They're essentially building local capacity and enabling the market to evolve without them. So this demonstrates the potential and the opportunity. And as we look at climate finance, I think a lot has been said about the challenges with the different forms of capital that is needed. So it's not just about debt. You need good, well-prepared projects with equity. We've worked with ARMRA on some projects where we've come in on the debt and they provided equity, which really reduced our due diligence process. And having institutional capital play that role in the stack is very important. And project development is key because, again, increasingly what is clear is that it's not just about the capital, but about the quality of the projects and the flow of the projects. And so, again, looking at the ecosystem in a way that we fill these institutional voids with institutions that are essentially set up to play that role in enabling markets. And so we see a gap in capital that should play a role in project development, ultimately connected to the equity and the long-term finance that could do the takeout. And so when the market acts closer together, and that's why increasingly we work closer with other actors in the local market, it addresses an asymmetry of information problem, which really plays a very key role in the problem we face with adverse selection. It's all a perception issue, really, when we look at the fact that if we talk more to each other, then we have less adverse selection problems and we have less defaults. And actually, we have a better, confidence amongst investors in the local market. So this has been our experience, and this is the way we're rebuilding strategies going forward. Also working with our development partners towards risk sharing. One of the things we've done very actively is going into co-guarantees and re-guarantees where we can actually share our risk. We've done this with institutions like ATIDI, the Africa Trade Insurance. We've also done this with Garanco. We're also looking to expand into other DFIs. So the question now for DFIs is, yes, you may have KPIs to lend, but you should have KPIs to provide risk sharing in terms of counter guarantees. To strengthen our capacity, we don't have to raise all the paid-in capital. We can use soft capital to support, capital mobilization on the ground. The size of pension funds today is roughly around 17 trillion, so roughly up to $20 billion or thereabout. 35% of that can be invested as domestic credit to the private sector, and less than 2% is. So there's a lot of work. Our total capital is roughly around $240 million. So even if we did 10 times our capacity, we haven't mobilized as much, and we cannot necessarily raise that in paid-in capital. So that plays a very key role in terms of how we see growth. But all in all, there is clearly a path. I mean, the model is proven that within Africa, there is an opportunity to leverage our domestic resources, build ecosystems that create assets that ultimately can be, asset classes in the books of our institutional investors, coordinate more, knowledge exchange, knowledge transfer amongst partners is key, and it's very replicable that, we could see this happen. It's already happening in Kenya. In Nairobi, there is the equivalent of InfraCredit being set up that AFDB Pitch is involved in. And we hope to see this model actually replicate itself across the continent, and where we stand ready to share knowledge as an institution, and we're already doing that.
Thank you very much, Chinua. So, I mean, the last thing you said is absolutely key. So what has worked already, and how can we share that knowledge, and how can we replicate that success in other markets? Because there's no point reinventing the wheel. So, from what Chinua said, in 2015, before InfraCredit existed, pension funds were not lending to infrastructure, investing up to now 20 years. They started with 10 years. Commercial banks in Nigeria are reluctant to lend, more than 5 years, 7 years? Even under the Basel rules, after 7 years, it becomes difficult because of, capital provisioning, et cetera. So there's a huge gap right there. And then the other thing is, project development, that early stage, patient capital, really important as well. And the role of the catalyst, you may provide guarantee to the first bond that is issued, and then the investors understand the sector. So when North-South Power came out for the second bond, they didn't require a guarantee because there was understanding in the market. So again, you need to demonstrate by doing what is possible, and then people start to get comfortable. So really, we're very impressed with the progress that you've achieved. What Chinua hasn't said is that there's a Harvard case study on InfraCredit. When I went to business school, one of the issues that came up was all the case studies that we were reading were from developed markets, what was happening in other places. For people who were going back home to their countries to work, why aren't we having our own case study? Because that's the environment that we're going in. So through this success, you're creating lessons for us practitioners in the African market. It was very instructive. So thank you very much for that, Chinua. So Chris, you've heard what Tari has said, what Chinua is also achieving. Based on your own global experience and what you've seen in Latin America, could you, please comment on how you see this landscape for local currency financing versus hard currency? What do our governments need to put in place? What do they need to think about? How do we blend what we can raise locally with what we can raise from, international investors? Over to you, Chris.
Thank you. Thank you, and thank you for inviting me. When I listen to these conversations, my experience, as you said, is more steeped in Latin America, which is where I grew up and where I was a banker for a long time. And these feel like conversations we were having 20 years ago in Latin America. The dilemma is the same. If you want to raise capital for long-term projects like infrastructure, in this case, we're talking about renewable energy infrastructure for the most part, at least at COP. You can either borrow long-term, but you have to borrow in dollars or hard currency, or if you want to and deal with the currency mismatch, if you want to avoid the currency mismatch, you can borrow in local currency, but often at very, very short tenors. So you have a maturity mismatch because you're investing it in a long-lived asset. Of course, most economists would say the way you solve that is by mobilizing domestic resources, pension fund reform, government savings in general. But that takes a long time. That takes a long time to develop those deep pools of savings. And those deep pools of savings often are reinvested under very strict terms, which often rule out local infrastructure investments, because there's this sense that a pension fund or a sovereign wealth fund should maintain the highest credit quality. So often they're invested in U.S. Treasuries, and that's not the most productive use of that capital. There have been some sort of extreme experiments in Latin America to simply move to the dollar, right, to dollarize. Argentina during the 90s, Ecuador, Argentina today perhaps. And these, by and large, have not been sustainable over long periods of time. The idea perhaps is right, which is that if you dollarize the economy, then everything on the asset side of the balance sheet and the liability side are in the same currency. You don't have a currency mismatch, but it becomes very, very difficult to manage it, because dollarizing tends to eat into competitiveness. And so there have been experiments which, Wale, I mentioned to you, which is why I find myself on this panel, I think, to introduce new units of account that are non-currency units of account, so there's no currency associated with it, but they're units of account indexes that are adjusted for inflation. And the central bank will maintain them, and because they're adjusted for inflation, their exchange rates vis-a-vis the dollar that move very gradually. But they allow for some slow depreciation over time so that the economy doesn't lose competitiveness. Chile has had something called the Unidad de Fomento, the development unit, since the late 1960s. In Mexico, it's called the Unit of Investment, or UDI, which was introduced in 1995. And these are attempts to sort of straddle that dilemma, not go all the way to dollarizing, because we know that that's untenable, but try to address this concern or this dilemma, which is that the only thing available in long-term capital has to be denominated in a hard currency. Try to denominate these in these units of account. Whatever loan is denominated in that unit of account or bond is not as exposed to inflation, and so maintains its value over long periods of time, and in turn can be used as a source of financing. These experiments, none of them are easy, but neither is the status quo. And so it's worth considering. The World Bank played an important role in developing local currency markets in places like Mexico by issuing in local currency and creating asset classes and creating familiarity. And so there are a variety of techniques and instruments that can be introduced, and ways of managing the real exchange rate that can be introduced, which may be worth considering. I'll leave it there.
Yeah, thank you very much, Chris. You mentioned some important things. There's this, the dilemma of having either currency mismatch or a maturity mismatch. So which one is the, what do you call it? The smaller devil, And then, yes, we do recognize, it takes time to pool local savings, which is, hard work that governments have to do, ultimately. In Africa, where we have 54 countries, what tends to happen is you have many small countries. So we're not, each country doesn't have enough savings. And for them to borrow in dollars, they have to have external reserves. Many of these countries are not selling enough to the outside world to build those external reserves. So the natural thing that we keep saying is that, why don't we all pool our savings, continental savings? But there are obviously political implications. In the Francophone bloc, they've tried to do that to a certain extent. They have a common central bank, and these countries put 50% of their external reserves with the French Treasury. But you said it, there are competitiveness issues. You know, what I say to my Francophone colleagues is that you can't establish a Dangote in Francophone Africa today because they're borrowing the stability of the euro. But then it favors the French companies to be able to sell into those markets. But if you want to set up production, manufacturing in those markets to export, it's not competitive. And it's more expensive because they don't have the infrastructure. So what you were saying is quite important, but then dollarization is not the answer. Zimbabwe has tried it. Zimbabwe is more or less a dollarized economy. But these guys don't print dollars. You know, if I dollarize and I don't print dollars, then I have to depend on the inflows and outflows of dollars from elsewhere, which is something that no government wants to. And the advantage of borrowing in local currency for government is that they can inflate away the debt. You know, they don't, that's why I'm surprised that the Ghanaian government asked local investors to take a haircut on local bonds. Because the easiest thing that governments do is they just print more money and they inflate away their debt. So dollarization is interesting, but it's not necessarily the answer. But you mentioned some interesting experiments in Mexico and Chile, where they're now using these non-currency units of account. So basically, in Brazil, they're still spending real on day-to-day basis, but if they want to borrow, they are borrowing in these units of accounts that are anchored by the central bank. Again, that's an interesting experiment that we need to learn from. So thank you very much for those thoughts. I think the point is not to reinvent the wheel and to learn from what others have done successfully. Interestingly, as you remember, after the Asian crisis in 1997, many of the Asian countries really put a lot of effort in reforming their local capital markets and being able to borrow in local currencies. So their sukuk markets grew. Countries like Malaysia, Indonesia, today you get there. But luckily, those countries have also had GDP growth, and they've also been exporting. So that's helped them quite a bit. Anyway, Vivek, you were there when India started its takeoff, and you were doing IPPs, some of the first IPPs in India, and then you've seen the migration from hard currency to local currency. And now leading the Africa Infrastructure Developers Association, you're trying to support local developers. And it's interesting because local developers are more likely to use local currency because maybe they don't have those networks to the international banks that provide the hard currency. So what are you trying to do, you know, based on what you've seen in India, and how can we flip this situation that we find ourselves in?
Thank you very much, Wale. Thank you for having me. Am I audible? Yeah, thank you. So you know, a lot has been said, and you know, I don't have a whole lot to add to that, but I'll talk about the role of getting deals done in a timely manner, the role of promoting replication and repetition that creates scale of activity. That's what I'm going to be focusing on. I run Africa Infrastructure Development Association. It's a non-profit, but we have profit-making developers, funds, DFIs, law firms, and service providers amongst our network, amongst our membership. Tariye, and we're very pleased to, my board member, Tariye, is here. I'm going to try to have to persuade her to keep her seat when she moves to CIF. What we look for is how can we be useful and effective for our members. And one of the issues is projects take too long to come together. Now, before we go there, let's talk about what is the role of local debt. There is a distinction in risk mitigation between risk elimination and risk allocation. When we buy a hedge, when we buy an interest rate swap, when we take a fixed price contract, either for EPC or for an offtake, when we have all of these things, we are allocating risk. You're paying somebody something to take that risk away. Local currency is a risk eliminator. It just removes the risk. There is something very special about people who use the infrastructure owning a piece of it. That incentive that kicks in But why doesn't it happen? And Vale mentioned that, is that there is a status quo already on how people are. People are happy to pay a premium and accept a premium and all manners on all sides of the transaction just because there's a trajectory of getting it done. Shifting the dynamics takes time, and that is another issue. Now, to give you an example, today in India, in a given year, there is about $10+ billion of investment that goes into renewable energy alone, wind and solar. All the financing is non-recourse by Indian banks. Equity, there's about $1 or $2 billion of pure equity that goes in. Most of that is international. They accept Indian rupee risk as part of that, and they have hedging. They do, what Terry was talking about, the velocity of capital. They have recognized that, and they figure that out. When I was developing my first project in India in 2007-8, it took me 2 years to finance a 25-megawatt project. We didn't have a choice. We didn't want to do it. We had US dollar debt, but we couldn't use it. So we had no chance but to turn to the Indian bank market. And I inadvertently ended up being the borrower of the first non-recourse rupee loan in the market. It was incredibly painful. But that was the genesis of this $10 billion plus of project financing in the market today. The question, what I'd like you to reflect on is, what led to that very difficult environment? What was the pivotal point to turn it into a very easy, repetitive, replicable environment? There were many things that fit in place over there. Now, actually, long before I came in, the Indian government, as a result of the '97 crisis that you mentioned, and their run-ins with developers like Enron that had dollarized contracts, they decided, enough is enough. So about 6-7 years before I came in, they decided there were only going to be rupee contracts. The stubbornness of governments in enforcing local currency contracts is very, very important. You can't get away from it, because otherwise the markets will just go off and pass that risk to the end consumer. So that's point number one. The collaboration and the coordination and the joint working, and that's one of the things I really love about the moonshot idea that you talked about, Vale, and that there is anything that brings a lot of actors together and they can learn together and implement things at scale, that has to be a valuable thing worth trying. And to give you an example, Africa Green Co is going to sign their first PPA later today, actually at 3:30. So 4:30, I think. And that's taken them 8 years to put together. But that's a very collaborative effort that has come together. The question is, how can we do this quicker and faster? So that's where I come to the Catapult Accelerator that we have within AFIDA, where that is essentially, we now have 17 developers, 10 clean energy developers, 1 telecoms developer, and now, as of 2 weeks back, 7 city developers from across Africa. And it is becoming a bit of a hammer where projects meet capital. That's the first thing. We make the introduction of capital a little bit easier. A second element of that of the Catapult is the training, is the peer-to-peer learning, the mentorship that goes along with that. None of these are working perfectly, but it's working. This year alone, we have set up a project finance, project development training course. We have trained 350 executives. We had set out to do a particular format that never worked. We started in Cairo with Afri-Exim's 19 Afri-Exim executives. I ran it in Accra for government and mainly for public sector, PPP heads of unit and Ministry of Finance officials from about 10 countries. And then again in Lagos in October, for Afri-Exim as part of their trade finance summit. We had about 350 public and private sector executives that took part in the course. That training is very important. And the third thing is engagement with government. We definitely, my opinion is, if we want foreign local currency or domestic savings to mobilize, we have to get governments to a position where they become really stubborn about it. in enforcing that. Otherwise, I don't see how the private sector is going to drive this on its own.
Fantastic. Thank you very much, Vivek. I mean, I totally agree with what you said about, the difference between risk elimination and risk allocation. Sometimes we think we've allocated risk to the party that is best able to manage it. But on this local currency stuff, you may find that, you have your PPA denominated in dollars. They'll tell you you're going to get paid in dollars, right? And then when it comes to time to make the payment, they'll say, okay, well, but we have the Naira equivalent or the shilling equivalent, but there's no dollars in the market. and so will you accept shillings or Naira? Of course you can't if you're a bank. You want to be paid in the same currency. And you could be sitting there in which time, you're losing, everybody's looking a lot. So some of these risks are really difficult, even on paper, when you've allocated it, to actually implement it. There never used to be issues with sourcing dollars in Kenya. But recently we found that to be the case. So long-term solutions, very important. And what you also said is, look, team working, making sure we're learning the lessons, making sure we're training, and getting government thinking the right way. Many governments, when we talk about savings, it's not something that a lot of governments think a lot about most of the time. And what I mean is like institutional savings at government level. Finally, quite a number of African countries are now creating sovereign wealth funds, which is a good thing. And then at the sub-sovereign level, there are many states, in places like Nigeria who go to Abuja to collect their federal allocation every month. They're not saving. And then personal level, because governments, in quite a number of countries, governments will sell savings bonds to the citizens, right? Our countries, we don't necessarily have those kind of instruments that allow government to go directly to the people. So savings at different levels. And obviously when people have saved, they need to have the confidence that those savings will not be worthless. And that's a covenant government has to enter, and that's why inflation is such an enemy, because you're inflating away. It's the savers that lose the most. So government policy, consistency, predictability, absolutely important. That's why you don't want to have 3 or 4 exchange rates, because it confuses the market. You don't get all of those things. Anyway, we've spoken enough. Let's open the floor up for discussion. Please feel free to comment on any of the things that you've heard, or if you have some other idea that you want to, throw in the mix, please also feel free to do that. Nobody's commented on the moonshot idea yet, so I'm also waiting for those comments. But when we call on the panelists to respond, maybe you can also make additional comments. So Gareth, over to you. Is it working? Okay.
Okay, thank you very much. My name is Gareth Phillips. I'm the manager of climate and environmental finance at the African Development Bank, working with Wale. Tariq, I'm very looking forward to working with you when you join the climate investment funds. We coordinate access with you, so I'll see you there in March, I guess. So thank you very much for these presentations. Very interesting. A bit out of my depth. I'm not a banker, even though I work for the African Development Bank. But what I'm interested in, a few things. I didn't hear any references to climate change. So, Chinua, in your portfolio where you have sort of zero defaults, are your assets at risk from physical changes in climate? And do you think that's going to alter your returns, or have you already built climate resilience into that? And Wale, in your moonshot, I noticed a little barrel of oil there, and my Paris alignment ears pricked up, and I wonder, you know, can you seriously put barrels of oil into a moonshot like this at a time like this at a climate change conference? So I'd like to hear your comment on that.
Okay.
And my last question is, there was a reference also to diaspora, and you know, we think there's a lot of currency, a lot of inflows coming from diaspora. And is there a twist to your quote where actually you could develop a country on money coming from other countries, but it's from the diaspora who live in those countries that are sending hard currencies back? So a few questions for you. Thank you very much.
Some food for thought there. Okay, yeah, let's group the questions a bit. Yeah.
Evening, well done to the panelists. So I work in Nigeria for a bank, Wema Bank to be precise. We have a number of customers that are looking into providing infrastructure, especially on clean energy. But if funding is not available, as we've all spoken, you need long-term funding. And like Terry mentioned as well, you need to bring in some assets that require dollars. And as a bank, these dollars are not available. And we really want to do this transaction because beyond making money, we're also doing good to the community and things happening. So how do you just oppose the two and ensure that these customers get this funding and we also get the infrastructure as a country? And also, what is the government doing to support this? I hear you talk about the Savings Mobilization Fund. There's something every month that the government open up for people to key in terms of savings. But it's small, but we don't even know what the money is being utilized and what is spent on. So how do we get all of this money to come into the pool that we have as commercial banks, support our own customers, and as well support the country as a whole? Thank you.
Okay, thank you very much. Are there any others? Okay, let's take the first set of questions. So Gareth said we didn't mention climate change. And are the investors at risk as a result of climate change in some of the projects that you're financing, Chinua?
So I'll answer in twofold. I think firstly is the deal actually did mention that we did the first guarantee and the second one without was a green bond. So it was a hydro 15-year green bond. However, I think broadly across our portfolio, in terms of the climate risk that could become potentially a default risk, we don't have that as a significant risk factor. However, we are working with development partners towards looking at how to climate-proof some assets, look at risk insurance products that could address, changing weather conditions around flooding and how that could, over time, affect certain assets that are located in parts of the country that have high sea level rising situations. So those are strategies that are being put in place today in terms of how we deal with portfolios today, existing portfolios. In terms of new projects, it's more around ensuring that they're climate resilient. And so we have an energy transition strategy and roadmap, so a clean energy roadmap that sets out our journey to net zero by 2050 and milestone-based approach to how we increase the percentage of our portfolio that is climate aligned. And under that strategy, we're focused on using a couple of key sectors such as energy access and housing as drivers of how we can expand our portfolio to more climate aligned assets. But we can't do that alone. We aim to work with our partners. Tari highlighted a very important point around equity is missing, right? But you can't wait for equity to come. You have to figure out other forms of alternatives which come in the form of blended finance. So where you get subordinated capital, first loss, subordinated funding coming from development partners that are willing to bear that risk, it actually plays a role of solving for lack of equity, to allow senior debt to come on the top of it, and then you can actually get projects to financial close. We've been able to apply that model for distributed renewable energy projects in rural communities. So our fastest route, for example, to universal electrification in Nigeria is going to be distributed renewable energy, which will serve over 90 million Nigerians that don't have energy access. So we have to think about what that means as infrastructure. The definition of infrastructure, is evolving to addressing the needs of the multi-dimensional sort of poverty that you see in most African countries. So as we redefine that as an asset class, as we work to create and expand that, so back to Vivek's point about repetition and skill, we can convert what is estimated as a roughly $16.6 billion funding required to achieve universal energy access to an asset class on the books of our pension funds. And possibly maybe up to 50% of that could be funded with blending. But what is it doing actually? It's creating jobs. It is creating financial inclusion, because these communities, by having energy access, by having access to even solar-powered, base stations, which we finance as well under that program, you're creating digital inclusion and also prosperity, which is where the pool of savings ultimately does come from. So you cannot delink capital market development with prosperity. They both come together, really, in my opinion. But someone has to do the hard work. And so I would look at all of this from first principles and in systems. I would look at it from, we have to do the hard work of building the domestic capital market. If you don't do that, even the climate finance we want to achieve needs to feed on an infrastructure. And if it doesn't exist, you're going to go back to the same fundamental questions. So maybe that's why we're working on first principles. You have to deal with this as you talk about climate finance. It has to feed on something. And if it's missing, then we're talking about currency risk on climate finance. It doesn't solve the fundamental problem that we're struggling with. So, but there's also an opportunity. So Tara is doing extensive work on VCMI, the Voluntary Carbon Markets Initiative, and we know the potential for carbon credits in Africa. So when we think about how carbon credits can de-risk assets, thereby reducing the capital cost, that is a very significant blending instrument, right, that could come to bear. And then we talk about diaspora money. I was joking that the national budget is about 20 trillion naira, and diaspora annual flows in Nigeria is about $20 billion. So you've got like the equivalent of your annual budget coming in, maybe you call it philanthropic capital or capital that comes in the form of, social investments coming home. So there's an opportunity to leverage that. It's how, we talk about these things, but how do we do it? There are models and hopefully how that could be leveraged. But I think as we think around these pools of, these are low-hanging fruits if you think about it, right? The innovation is now trying to reconfigure how these capitals can flow, but it all has to be driven by something. There must be a system that we're trying to build upon. So fundamentally, we must build the capital markets. We must create asset classes that come into those markets, and that comes with prosperity, comes with job creation. Because we can't achieve these ambitions we talk about with a high poverty rate. The countries that we talk about have a better quality of life across many, and it's the savings that we need to reconfigure. So when we think about the financial architecture reconfiguration, we need to think about it within the context of even Africa and African countries and how we're seeing how that can also evolve, right? So that would be my take on this, and that is my own moonshot sort of idea, yeah.
Okay, cool. I think Taria wants to come in, and then I also wanted to get, I think Chris and Vivek, because Chris is doing something very interesting with carbon, which we didn't talk about. And since Chinoa mentioned carbon and how we can use that to benefit Africa, maybe we'll touch on it a bit just to keep Gareth happy that we're talking about climate and carbon. But Gareth doesn't like carbon, actually, but we're going to talk about it. Did you want to? Yes, please. Yeah.
Thank you. No, I think the point made here is that the climate is a given. Ultimately, ARM Harith, the successor fund of ARM Harith is an energy transition and climate transition fund, or climate infrastructure fund. It's actually called the ACT Fund. And we're very proud to have been selected in 2021 as one of the top 6 ideas from the Global Innovation Lab for Climate Finance, which is managed by the Climate Policy Initiative. And we received tremendous support from an international working group comprised of government representatives from the UK, Germany, as well as the IFC, as well as different American, pension funds, such as BlackRock as an example, that basically came in to advise us on our climate criteria because they were very excited about this path toward integrating local currency alongside international capital. And they saw that as a model that could be replicated across other emerging markets, where if, in fact, we'd actually be sharing an African-led experience across the global market. And so very much our focus has been on delivering that. We have a $300 million energy transition emissions reductive transport type projects, as well as other forms of climate beneficial infrastructure. Could be clean cooking, methane reduction from landfill. And that $300 million worth of infrastructure, I think only one of those projects has a sovereign guarantee that's going to guarantee my revenue in dollars, which means I've got to figure out local currency solutions and means to manage investing dollar equity into these assets. And that's why these conversations have been very important to us, because we're not going to solve the climate transition without having local currency solutions. And even if you look at the G20 report on improving the MDBs and the financial system architecture, of the $2.4 trillion that's needed for EMDs for climate, about $1.9 trillion needs to come from domestic capital. So we've got to solve this problem, and there's a huge need to green African portfolio, green the pension fund portfolios. But a lot of that's going to be done from policy work as well as test cases. And one of the things that we've also experienced, and we because we're in the market, what we've also learned about Nigeria and Africa is it's actually the projects that deliver the policy change. You've actually got to have that first renewable energy project, that first bus rapid transport, electric, e-bus retrofit project that's going to deliver on the policy change, which is why in some respects we tend to be moving ahead. I want to touch on adaptation and resilience. Our distributed renewable energy aggregator, it basically aggregates $1 to $2 million projects in the off-grid space, both off-grid, interconnected grid, etc. When you run the GHG emissions calculations for off-grid, it's really not very emissions reductive because they're not consuming energy. What it is an adaptation play. It's a resilience play. And so one of the things we've done, again, with the support of this technical assistance we got from Sustainable Energy for Africa, is working on an adaptation toolkit that we're basically sharing with our sponsors. We're actually going to be funding African developers as well as international developers off-grid, and saying, how can we use the capital we're bringing in to fund processing, drying, cold chain, refrigeration, irrigation? Because one of the greatest risks when it comes to climate and extreme event impacts is food security, actually. And so if we can sort of enhance resilience with our energy interventions, we're actually at least making an impact from our sort of standpoint.
I couldn't have said it better myself, Terry. So listen, we have something called a global carbon market utility, Chris. What is this going to do to help developing countries like African countries to generate additional capital to finance green infrastructure?
Well, thank you for the opportunity to plug the new global carbon market utility, which is very much in its infancy, but an exercise in creating the infrastructure that's needed to make the voluntary carbon market familiar to anyone who's familiar with other markets. Because our theory of the case is that unless and until it has all of the mechanisms and infrastructure that a conventional market would have, it's not going to scale up. It won't move beyond the very low levels it is now. But if we're successful, then among other things, it's an opportunity for the continent to unlock all of this locked up potential. Because there's so many projects that can generate credits because they either reduce or remove or avoid emissions. And if we're successful, we will also be able to make what you can think of as a potential new export sector, one in which the lion's share of the proceeds of those exports actually end up back in the exporting country, which is not what one could say about the transactions that we see now. So that's what we're trying to do. We're working together with ACME and many others. There are lots of stakeholders who have been working on this for a long time, but But we feel like there's still a few missing parts, and that's what the GCMU is going to do. If I could just answer a couple of other, there was a question about the diaspora, which is also a perennial in Latin America, as I said, which is more familiar to me. Diaspora bonds have been tested, but are not really a very good source of development capital. But what some countries that have a lot of remittances, in the case of Latin America, Mexico is one, there have been instruments developed around remittances to essentially securitize remittances, which can unlock actually quite a bit of capital. And so to the extent that remittances, countries with high levels of remittances want to explore that, it's worth using. And then on incorporating climate change into investment decisions, it turns out that that as sophisticated as project evaluation and project finance is, and it's, the toolkit has been developed over decades, it does a very poor job taking into account climate risks, especially secular climate risks that will only have an impact 20 or 30 years from now, even though in infrastructure you're building assets that should easily have a lifespan of 20, 30 years, maybe 50 or 100. It's a little mystifying to me, but I've been involved in some efforts to try to enhance the methodology for evaluating these and to home in on the small, modest investments that can be made at the beginning to make a project, whether it's a transportation project or a housing project or some other kind of infrastructure project, that much more resilient to climatic perils that we know will come down the line. So there's a lot of work that needs to be done there still.
Fantastic. Thanks, Chris. I think Vivek wanted to say a few words as well.
I have on three occasions invested in diaspora bonds issued by the government of India. Not by the government itself, they don't issue bonds, but State Bank of India, for example, has taken it. Very successful if it's done properly, and long-tenured bonds.
But they're not. But the amount of capital that's raised is not
Huge.
so. Is
Huge.
it in the case of India?
Yeah. I mean, there were something like $20-30 billion was raised and stuff like that. So big amounts of money. But on the bank, so I've worked with. In my early years, 30 years back at ING Bank, when we went into long-tenured project finance, working on the first non-recourse loan in India, the typical problems that banks face when they're first going into the sector is that of tenor. The long tenors that we have, the maturity of the loans, that is an issue. A second issue is the depth of capital in the market. I mean, if Azura had to be financed entirely in the Nigerian market, it'll blow pretty much every bank's single credit, single borrower limits, for example. Third is the architecture within the organization to actually assess, monitor, evaluate on a long-term basis how a project finance credit is doing. So some of these are trading issues. Some of these are others are an issue of the velocity of capital that Tariya mentioned, and that long tenors scare people, but actually, and then of course there's a capital allocation that Basel III or whatever requires, or we are dealing with Basel IV right now. But banks discovered and have discovered in markets again and again that actually the tendency always has been to hang on to a good performing loan and earn that interest through to maturity. That's the wrong approach. Banks discovered that actually 3 or 4 years into a loan, if it is well performing, the sponsors will want to monetize that by either selling it or aggregating or refinancing it and things like that. And that should be encouraged. So you might have a 15-year loan or a 20-year loan, but that is getting refinanced every 3 or 4 years, makes it a 3 or 4 year loan. And that practice, that positive dynamic in the market encourages the liquidity and the scalability. But very important is to get the execution capacity in place to put in these loans quickly. If it's going to take 3 years to get a loan financed, whether it's in the local market, international, it's not going to work. You have to get it down to a pace of doing it in every 3, 4, 5 months in terms of lending it. So that's the skill, and that's a training issue. And that's about getting the architecture within the bank right in terms of credit assessment, in terms of monitoring, in terms of evaluation. And we've seen banks everywhere in the world go through that journey. It's beautiful, but it works.
Okay, thank you very much. We have to wrap up. Do you have a quick question before we wrap up? Okay. How long do we have? I think we have until the hour, right? So please, go ahead.
Everybody, my name is Shubhranil Majumdar. I'm the Chief Operating Officer of the Resilient Water Accelerator. I just wanted to ask Chinua and Tarya is just to, like, what are the key learnings from financing clean energy infrastructure into other sectors, especially complex ones such as water? Because we see that investing in water assets has not kind of taken up as it is in other sectors because of the lack of bankability issues, some of the creating enabling environment like still not there. We expect some kind of government guarantees. And I was an ex-IFC, but we didn't have also like a large water portfolio. So just wanted to intrigue, like, would there be still a long waiting period before we see investments into water sector, or we can learn from some of the clean energy investments and what needs to be done to kind of build resilience in the water sector? Thank you.
Thank you very much. So again, I think, obviously I also get your thoughts as well on this, but my experience just observing the market is we tend to have a definition of what maybe a predisposed definition of what infrastructure is because of what we see in other markets. So like in Nigeria, we assume that energy, before now, in a lot of African countries, we assume that energy access needed to be centralized grid. Right now, today we realize it's decentralized and can be distributed, and that is now infrastructure. It wasn't infrastructure a couple of years back. Same way we look at water, and it's also centralized, right? The distributed, the typical centralized water systems. And there seems to be a similar thinking around how should water, water as infrastructure be defined? How are we actually utilizing water? So in most markets, you would find that actually is largely decentralized. A lot of the centralized water infrastructure are not really functioning because the maintenance cost and also the challenges that come with it. So you find that you have trucking moving water more often. You have community-based distributed water solutions. So the question is, it appears water is modular, is being distributed just the same way we have energy, the DR, distributed renewable energy. We're seeing some behavioral patterns. So again, you look at how people are actually utilizing the infrastructure. In every community, or whether it's a master plan community or an NST, they build their own water utility within. And then they don't entirely depend on the centralized water system that the state brings. So maybe when we think more about the way in which water should be reconfigured as an asset class or as an infrastructure, maybe that in a way could address some of the challenges we tend to struggle with. The PPPs we've seen obviously require a lot of viability gap funding coming from the state. And the capacity to do that is also a bit of a challenge. So a combination of looking at the business models for water as an asset class and the type of way we think around the viability gap funding. To what extent can we look at other forms of, if it's structured to be climate aligned, what other forms of money can come in to bridge that gap for the viability funding? But my interest a lot is really looking at the distributed model for water and which markets is it currently sort of working on and how replicable could that be. But I'd agree with you that we haven't seen that many PPPs for water work successfully. We've seen a lot of donor money going into studies, so we don't want more money going into studies. I think we know enough. So we hear, $30 million for water, but everything went into studies. Nothing went as capital into the project. So I think, hopefully we do lessons learned, we do a bit of comparable in other markets, and then we're able to probably rethink how best we can finance water as an asset class.
Fantastic. Chinua, we have to bring this conversation to an end now. I think people have to go to other sessions. So let me thank everybody for listening. It's been a very interesting conversation. Let me just leave you with one thought, Gareth, in relation to the moonshot idea. What we're facing now is a situation in which Africa has a lot of green minerals. And we don't want to get into the mistakes that we made with fossil. So if we create institutions that allow us to benefit from the way in which we're selling and distributing these green minerals, then this moonshot idea actually plays into that. So that barrel of oil that you saw there will be replaced by lithium and some other green minerals. But thank you so much for your attention. We've had a fantastic conversation. Okay, thank you. So, thank you. Let's